Have you ever watched currency exchange rates bounce around day to day and just thought, wow, that looks completely random? One day the dollar's up, the next it's down. Well, it might look like chaos, but behind the scenes, there are some really powerful forces at play. We're talking everything from big economic theories to the nitty-gritty strategies of traders looking for an edge. Today, we're going to pull back that curtain on the foreign exchange market. So here's the plan. We'll start with the absolute basics of how a single currency exchange gets its price. Then we'll get into the golden rule that keeps this whole global market from flying off the rails. We'll look through three main economic lenses to understand long-term value, see how traders try to profit when those rules get a little bent, and then we'll zoom way out to see how entire national economies get in on the action. Finally, we'll tie it all back to you. All right, let's jump right in. Okay, first up, the price of money. So what is an exchange rate, really? I mean, it's not just some number flashing on a screen. It's a price, and it's being set in the biggest, fastest marketplace on the entire planet. Let's make this real. Picture yourself at the airport, super excited for a vacation. You walk up to that currency exchange counter to swap, say, your dollars for some euros. But what actually decides the rate they show you up on that board? Well, the first thing to know is it's not just one price, it's two. And this is where the house always has an edge. The dealer is willing to buy a currency from you at one price. That's the bid, but they'll sell it back to you at a slightly higher price, the offer. That little gap in between, that's called the bid-offer spread, and it's their guaranteed profit on the transaction. Think of it as the first little toll you pay to get on the foreign exchange highway. So you've got trillions of dollars zipping around the globe every single day. What on earth keeps all those prices in line? Well, there's a kind of golden rule at play, and it all comes down to one simple fact. The market absolutely hates a free lunch. The enforcer of this rule is a concept called arbitrage. You can think of it as the ultimate form of high-speed deal hunting. If a trader's computer spots the euro selling for a fraction of a penny cheaper in London than it is in New York, it'll instantly buy in London and sell in New York for a tiny but guaranteed risk-free profit. That action, multiplied by thousands of computers doing the same thing, is what slams that price gap shut almost instantly. And this doesn't just happen between two currencies. Check out this little loop, what's known as triangular arbitrage. A trader, or more likely a super-fast algorithm, spots a tiny pricing mismatch between the dollar, the euro, and the yen. They can start with $1 million, use it to buy unusually cheap euros, use those euros to buy even cheaper yen, and then sell those yen to get back more dollars than they started with. It's literally a risk-free money-making machine. But, and this is a huge but, these free lunch opportunities last for milliseconds. I mean, we're talking about the blink of an eye. There are whole armies of high-speed trading algorithms built for one single purpose, to sniff out these tiny pricing glitches and pounce. Their relentless hunt is what forces prices into lockstep across the entire globe, making sure there's no easy money just sitting around. Okay, so if arbitrage keeps prices consistent moment to moment, what determines a currency's actual value in the long run? Well, for that, economists have come up with a few really powerful theories that act as our guideposts. First up is purchasing power parity, or PPP for short. The core idea here is actually pretty simple. A basket of goods, things like groceries, a car, maybe a haircut, should cost the same in New York as it does in Tokyo once you adjust for the exchange rate. If it doesn't, that means one currency is probably over or undervalued. At its heart, PPP connects a currency's value directly to inflation. And this slide right here shows PPP in action. Just look at the chart on the top left. Over a one-year period, the link between inflation and exchange rates is, well, it's a total mess, just a random cloud of dots. But now, watch what happens as we stretch out the timeline. Let's move to the next chart, over 6 years, then over 12 years, and finally, check out the 24-year chart on the bottom right. See that? The data points get pulled tighter and tighter to that perfect diagonal line. The long-term trend is crystal clear. High inflation will eat away at a currency's value. Our second lens is interest rate parity. Okay, imagine you have two bank accounts. One is in the US and it pays you 2% interest. The other is in the UK and it pays 4%. It seems like a total no-brainer to move your money to the UK, right? Well, interest rate parity says not so fast. The theory suggests that the extra interest you'd earn in the UK should be perfectly canceled out by an expected drop in the British pound's value. In a perfect market, you can't get a risk-free gain just by chasing higher interest rates. So we just said that in a perfect world, you can't profit from those interest rate differences. But we don't exactly live in a perfect world, do we? And that's where traders come in, with a strategy specifically designed to exploit that gap between pure theory and messy reality. This brings us to the famous FX carry trade. It's one of the most popular and definitely one of the riskiest strategies out there. Here's the basic recipe. A trader borrows money really cheaply in a country with low interest rates, like Japan. Then, they immediately sell that yen and buy a currency from a country with high interest rates, like Australia, and they invest it there. Their profit is the carry, that nice, juicy spread between the two interest rates. The whole bet hinges on the hope that the exchange rate doesn't move against them enough to wipe out those gains. But there is a massive catch, and this quote gets right to it. The carry trade is often described as picking up nickels in front of a steamroller. That bit about fat tails and negative skewness, well, in plain English, that means you make small, steady profits most of the time. But you are exposed to these rare, sudden, and absolutely huge losses. It's a strategy that works beautifully, month after month, until one day it suddenly and catastrophically doesn't, and it can wipe out years of gains in an instant.
All right, so far we've been looking at market mechanics and trading strategies. Now let's zoom all the way out to the macro level. How does the health and the policy of an entire country actually move the needle on its currency? The starting point here is something called a country's balance of payments. The easiest way to think about it is like a national checkbook. It records every single dollar, euro, or yen that flows in and out of a country. We're talking everything from exporting cars to importing iPhones, from foreign companies building factories to local pension funds investing abroad. And just like with your own checkbook, if a country is consistently spending more money abroad than it brings in, it's basically living on credit. And over the long haul, that puts some serious downward pressure on its currency. This leads us right to the Mundell-Fleming model, which is a fancy way of showing how a government's big decisions directly steer its currency. When a central bank messes with interest rates or when the government changes its spending plans, those actions don't just happen in a vacuum. They create waves that ripple right through the economy and hit the exchange rate. And this matrix here maps it all out for us. So on the vertical axis, you've got monetary policy. Is it easy or is it tight? And on the horizontal, you've got fiscal policy. Let's just pick one combo. Look at the bottom right box. If a government cuts its spending, that's tight fiscal policy, and the central bank jacks up interest rates, that's tight monetary policy, the model predicts the currency will appreciate or get stronger. Why? Well, because those higher interest rates act like a magnet for foreign investment, which pushes the currency's value up. Each one of these boxes shows a different policy mix with a different outcome for the currency. Whew, okay, we've covered a lot of ground here, from that little spread at the airport exchange counter all the way up to massive global capital flows. So let's bring it all home and boil it down to the most important takeaways. So when you ask, what really moves a currency, it all kind of boils down to this tug of war between four key forces. Over the long, long run, inflation is like gravity. It is always, always pulling a currency's value down. In the medium term, interest rates are like magnets, either attracting or repelling global capital. And then shaping all of this are the daily tides of a nation's trade balance and the big policy choices being made by its leader. You know, this quote perfectly sums up the whole challenge and really the opportunity of understanding currencies. Yes, the day-to-day movements are basically a random walk. They're totally unpredictable. Trying to guess tomorrow's rate is pretty much a fool's errand. But the economic theories we've talked about give us a powerful anchor, helping us figure out where a currency's true long-run value ought to meet. And that is really the key takeaway here. The goal isn't to become a fortune teller. It's to become a better interpreter of the world around you. Now, when you read a headline about a country raising interest rates, or you hear about its trade deficit getting wider, you'll have the mental framework to understand the real story that's unfolding for its currency. So, I'll leave you with a challenge. Thinking about those fundamental drivers we just talked about, inflation, interest rates, trade, and government policy, which major currency do you think is sailing into the strongest headwinds, or maybe the strongest tailwinds over the next year? The tools to start figuring that out are no longer just theory. They're your new lens on the global economy.